Hi, everyone. I'm Michaela with Retirement 567, here to introduce Fred Pratt Sr. and Fred Pratt Jr., qualified financial advisors, here to talk to you about taxes and retirement on behalf of 567 Workshops. Go ahead and take it away, Fred.
Thank you, Michaela. I hope everybody's doing well. So, ladies and gentlemen, we're at the doorstep of a historic moment. We're facing something in Canada that has never been seen before. This is not a single event, but more of a condition or situation that is starting to unfold. It's getting bigger every day, and it will absolutely affect every person on this call. It will have dramatic implications for our country in the next 30 years. What makes this situation so potentially dangerous is we have never dealt with anything like this, but it's coming like a freight train and no one can stop it. You're probably wondering what I'm talking about. The answer may actually surprise you. I'm talking about retirement. I'm talking about the baby boomers, the largest generation of people born in the history of this country, retiring. Now, retirement is nothing new, and we understand what it means, but this is the first time where we will have this many retiring at once. In fact, it's projected that more people will retire in the next 15 years than in the cumulative history of our country. What makes this situation even more dire is the fact that this is the first generation that will be living 10, 20, even 30 plus years into the retirement. Now, when the Canada Pension Plan was put in place in 1965, the average life expectancy was only 71 years old. Both Canada Pension Plan and Old Age Security are at a significant risk of being underfunded. I don't want to scare you. I just want to tell you the truth. That truth is you need to take care of yourself and your family. This is why we are here today, to give you ideas and strategies that will help you take control of your future. Now, we can't solve the retirement issue in one webinar, obviously not. But my goal, our goal, is to get started on a path where you and your family will not only survive retirement, but also enjoy this part of your life that you've worked so hard for. My name is Fred Pratt, and this is my son, Fred Pratt Jr., and we will be your guides on this journey into the world of retirement. Take it away.
Yeah, so hi everybody. Yeah, I'm Fred Jr. We wanted to give you a little bit of an intro, a little bit of a biography on ourselves so that you know who you're talking to. So I went to the University of Ottawa. I graduated in 2014 in both finance and accounting. Didn't really like accounting all that much, so I decided to go into the finance role. I was also on the University of Ottawa golf team back in the day, and we would play against NCAA Division II schools in the United States, and they would kick our butts pretty good. So I realized I wasn't going to become a professional golfer. So decided to go into financial planning and join my dad. I've been doing this for about 6 years now. I also started a little initiative called How to Adult. There's a lot of young professionals that came together. We have an accountant, a lawyer, a real estate agent, a mortgage broker, and basically, yeah, we just feed off each other. So if we don't know the answer to something, we can definitely lead you to somebody who does have the answer to it. So
perfect. Yeah. Okay, so I've been doing this for 16 years now. Really enjoy what it is that we're doing. Prior to this career, I was actually in the sawmill industry, believe it or not. I'm a forest technician by trade. And I guess my claim to fame is at one point in time, we were making this wood component that was turned into baseball bats. And this wood component was actually making baseball bats for a guy that maybe some of you have heard of. His name was Barry Bonds. I think it was back in 2000, 2001. He was the record holder of home runs, which still hasn't been beaten. And we really thought it was because of our wood. And little did we know back then it was actually maybe a combination of both wood and steroids. So anyway, just
we have some memorabilia of the baseball bats here at our office. So.
Yeah. So like I mentioned, I got into this career about 16 years ago. I haven't looked back. Love doing what I'm doing, and I really love working with this young man here. We are a family-run business. There's the both of us and my spouse and my stepdaughter that we hired a couple of weeks ago. So I guess we'll get going here.
Yeah, so just before we start, a few housekeeping items. There is a Q&A function where you can type your questions. It's a private chat, so we'll be the only ones seeing the questions. We're going to try to address them at the end, but if not, we are offering complimentary consultations, strategy sessions. You'll get a few prompts throughout our presentation to actually book a consultation with us. You can click on that prompt without exiting the presentation itself. There it is, just popped up. You can click on it without exiting the presentation itself, so feel free to click on it whenever it appears.
Again, it's your face, not mine.
Yep.
I don't like.
I'm the better looking one. That's
Yeah, okay.
Yeah. So
You know what? I made you a long time ago. I could get rid of you and make another one that just looks exactly like you. Anyway.
Yeah. Okay. So
Yeah.
now, enough fun. Now, just
Okay.
in case we have any lawyers in the audience, we like to put this little disclaimer here. The strategies you hear today should only be considered while working with professional advisors, and that's just for your own benefit. So to begin, there are some basics we need to know to plan for retirement, like how many years do we need to fund it? So to know that, we need to know what the average age of a Canadian retirement is. For a public sector employee, it's about 61 years old. Private sector employee, it's around 65. Self-employed person's around 67 years old, and the overall average is 64 years old. So now we need to find out the average longevity of that retirement to get an idea of how long it's actually going to last. So these are the average mortality ages. Most people know that in Canada, the average life expectancy of a woman is around 83, 84. For a man, it's about 79, 80. But if you're already 65 today, then those life expectancies actually increase to 87 for a woman and 84 for a man. So this would suggest that there's about 20 to 22 years worth of retirement. However, we know the better educated you are, the healthier you live, the longer you're likely to live. And there's a good chance that at least one person in a couple will make it past age 90. So that could easily mean 30 plus years into retirement. So we really need to plan to fund that. Now, these numbers show the problems that the government will have funding programs like Guaranteed Income Supplement, Old Age Security, and Canada Pension Plan. In 1973, for every one retired person, there were 8 people working. In 2013, there were 4 workers per retired person. It's projected that by 2050, there will only be 2 workers per retired person. So that's pretty scary in itself. And also, as a result of COVID, we now have an even larger deficit, as we all know, which means one of 2 things, and most likely both, higher taxes and bigger clawbacks on social benefits. Now, aside from your own personal goals for retirement, finance professors Ho and Robinson suggest that these 3 are critical factors in ensuring the basics of a good and happy retirement. So you want to minimize the risk of outliving your money, maximize the income available to your family, and you want to actually maximize what you're leaving behind to your heirs. Funding your retirement comes down to these factors. Government pensions like Canada Pension Plan, Old Age Security, and Guaranteed Income Supplement are available to all Canadians. That Guaranteed Income Supplement is for lower income people. Canada Pension Plan is based on the amount of years you worked and how much you actually contributed to the program. Old Age Security is available for everyone over 65, but has the potential to be clawed back if you're a higher income earner. Then you have things like a defined benefit plan where you know exactly what your pension income will be. Defined contribution plans and deferred profit sharing plans are also great. They don't give you a guaranteed income in retirement, so they have to be managed similar to an RSP or a RIF. And then the TFSA, greatest thing any government has ever given us, so make sure to utilize that. And then you have any non-registered assets like your home, investments, or maybe a cottage.
Yeah, we actually do a lot of work with TFSAs.
Yeah.
In retirement, yeah.
Yeah, so tax lawyer and author Christine Van Koenberg rightly points out here that we have to be very strategic in our tax planning once we hit the age of 65, and that's due to clawbacks on social benefits. So it's the reduction of net income for tax purposes, not necessarily the reduction of the amount of tax you pay, that is of most concern to seniors and retirees, and that's due to clawbacks on these things here. So let's say you're making around $18,000 a year. we're going to do our best to keep you under the $18,600 mark so you can maintain your full guaranteed income supplement. If you're making around $50,000 a year, then every dollar of income we take away gives you more of an old age tax credit. Same with the old age security. We're going to do our best to keep you underneath 79,000 so that you can avoid getting the old age security clawback. But even if you're above 79,000, every dollar we're saving you is saving you more of that old age security clawback. So we're always focused on that. So now I'm going to pass it off to Fred Senior to talk about retirement income and assets.
Okay, very good. So as you can see on this chart, the government compares retirement income like the structure of a house, with social benefits providing the foundation and second floor, while private savings and private pensions tops it off. These are the maximum benefits available from the government from these two programs. They are designed to fund approximately 40% of your retirement income, meaning that the remaining 60% comes from your savings from different vehicles such as RSPs, TFSAs, private or government pensions, and non-registered monies. Based on this slide, the average Canadian needs to save $30,000 worth of annual income for at least 20, if not 30 years. We could be looking at almost $900,000 that gets paid to you over your lifetime. So this next pie chart, I'd love to ask you a question. Does anyone notice anything strange here? I'll give you a couple of seconds to look at it. Meanwhile, maybe it's a good time now if you do have other questions that you could ask away.
Absolutely.
Okay, so notice that the Canada Pension Plan is providing less income than the old age security. Yet we just saw that the Canada Pension Plan can provide almost twice the amount of OAS. So how's this possible? I'll give you a couple more seconds to think about that. And there are different answers here. So Canadians can take their CPP as early as age 60. If you do so, your amount is actually reduced by 36%. Now, the reverse is also true. You could wait till age 70 to take it, meaning that the amount will increase by 42%.
Yeah.
We're starting to see a lot of that because people are living a little longer. They're actually working longer.
Yeah.
And some people have significant assets. So we're actually delaying that CPP and old age security payment.
Yeah.
Okay. Another answer is Canadians don't earn enough money to be able to max out on the CPP contribution. You also need roughly 39 years to be able to max out. And one thing that we're seeing a lot of is immigration. So if you have people coming over that are 40, 50, 60 years old, again, they don't have that time needed to max out on the full amount of the Canada Pension Plan. Okay, so let's get going here. Okay, so our challenge in Canada is that we're taxed at all three levels of government, the federal, the provincial, and municipal. And as history has shown, taxation has increased over 2,200% since 1961.
Yeah.
Folks, that is not a typo. That's 2,200%. So what exactly did this slide mean? Well, if you were around in 1961, and let's assume that your tax bill back then was $100, and you're around today in 2018, you're actually going to pay $2,346. Significant increase. Now, we need to understand that inflation is a factor, but this next slide proves that there's definitely an element of greed, mismanagement, and ferocious appetite for spending when it comes to our three levels of government. Food, clothing, and CPI have only increased by 6 or 7 times, and our incomes and housing have increased by roughly 16 times, while our governments have increased taxation by 22 times in the same time period. That's significant.
Yeah.
Now, most Canadians say they are willing to pay their fair share of taxes, and we definitely agree with that. But we just want to make sure that the government is spending our money wisely. Well, back in 2013, the Auditor General blamed the federal government of up to nearly $200 billion in waste. Now, we need to put this into context. This is the Auditor General actually saying this. This is one of their employees.
Yeah.
Okay. So, despite the claims of present government working to help the middle class and those working hard to join it, we've heard that a lot of times. The numbers suggest otherwise. Although the marginal tax rate has decreased from 22 to 20.5%, most middle class families are paying more tax than ever before. So how's that possible? As the Fraser Institute shows us, we lose a lot of our income to many forms of taxation, some direct, like income taxes, some embedded and invisible. On average, income taxes only account for about 31% of all taxes that we pay. So although a tax break was given on income, taxes were increased elsewhere. In fact, we have so many different forms of taxes, the government has run out of ways to name them, so they named them other taxes. Now, as you can see near the bottom of this slide, third from the bottom,
Yeah.
what the Fraser Institute really shows us is that we are paying 44 cents of combined tax on each dollar that we earn. We are left with a 56-cent dollar. We actually start earning our own money starting June 11th of each year, meaning we're
We're
about 2
April
months
now,
away.
2 months away, you'll start making your own money.
Yeah, so all the monies earned prior to this go to government. So for us to do any kind of tax planning, we need to understand how we are taxed. We need to understand the basics of how government taxes our incomes through the marginal tax rates at the combined federal and provincial levels. This table explains how our graduated tax system works. Essentially, the more money you earn, the higher percentage of tax you pay. It's like a double whammy. Now, as financial advisors, we have to work with these marginal tax brackets to help us optimize tax effective strategies for our clients. As you can see, anyone earning over 220,000 is taxed at 53.53%. Now, some of you might say, I don't really care about this, screw the rich, they could afford it. However, you may think because you've never earned this type of income, this has no direct effect on you. This next slide may actually change your mind. So Canada is one of the few countries in the world that doesn't have an estate tax. This was eliminated back in 72 under Pierre Elliott Trudeau. We have what you call a deemed disposition, meaning your estate is taxed fully as of the date of death. This means potentially that your estate holds more than $220,000 of taxable assets like RSPs or RIFs. It could be driven into that top marginal tax bracket, which, as mentioned, in Ontario is 53.53%. This means you have to consider both your retirement and estate taxation together when making tax planning decisions. The last thing you want to do is die with a lot of registered money. Now, folks, if there's anything that you walk away with from this presentation, remember that one, okay? You do not want to die with a lot of registered money. We have solutions for that, okay? So what can we do? Finance professor Mosh Milevsky, the most written academic in the world, suggests we treat our finances the way a company would. We need to be very strategic with long-term vision, operating as You Inc. to maximize and optimize our financial well-being. So if we get started here, we can look at tax planning and we could break it down into these 5 categories, which hold the potential of incorporating 40 different tax strategies in total. No one will ever be able to use all these strategies, but if we can implement 5 or more of these that you may currently not be using, we can actually put more money in your pocket than in the government coffers.
Yeah.
So I'll pass this on to you.
Yeah. So what everybody came to see, some strategies. So
the fun stuff.
The fun stuff. Well, at least we find it fun. Yeah. So everybody knows there are 3 forms of investment income: interest, dividends, and capital gains. Interest is taxed at whatever your marginal tax rate is, and as we saw, it can be as high as 53.53%. Dividends are taxed slightly less than interest, around 67% of what interest would be taxed at. And then capital gains are the most favorable form of taxation, being taxed at 50% of whatever interest would be taxed at. So considering all this, it's normally better to hold interest and dividend investments in your registered portfolio, and you're better to hold capital gain bearing investments in your non-registered portfolio. For those of you who are over 65, you need to be cognizant of the dividend gross up on your net income. It's an artificial gross up of your income that will affect clawbacks on GIS, old age security, and your age credit. So dividend bearing investments are great, don't get me wrong, but you're probably better off keeping those in your RSP and your TFSA just because of that artificial gross up that doesn't actually make you pay more tax. It just makes you have, clawbacks on social benefits.
Yeah.
right? So then you have severance payment spreads. Yeah, so you can actually spread this over multiple years. For anyone who was forced to leave a job, you might need to fight with your HR department for this one, but you can absolutely spread a severance payment over multiple years to reduce your tax liability. Capital gain spread. So wherever and whenever you're triggering capital gains, if possible, spread them over multiple years so it helps keep your income lower. This one's a little bit more rare, but it's definitely advantageous to spread those gains whenever possible. Yeah, optimizing your TFSA. This is the best long-term savings plan offered by the government since the advent of the RSP in 1957. It came into existence in 2009, where you could put $5,000 per year. Now we're up to $6,000 per year. There was a few years there that were around 5,500 and 10,000 that one year. So if you were at least 18 years old in 2009, which I feel like most people on this call would be, and you've never contributed to a TFSA, then you can contribute 75,500 today. It's amazing how often we see people with a good amount of non-registered money
Sitting in a bank.
and they don't have their TFSAs maxed out, or they might not even have a TFSA at all. So that is step one. If you have non-registered money, put it in the TFSA.
Assuming you have the room.
Yes, exactly. So corporate class funds are a tax-effective tool for individuals with higher amounts of non-registered assets that are to be invested for the longer term. So investing in corporate class funds can help build and protect your wealth by deferring and minimizing your taxes on non-registered investments. And that just leaves more money in your portfolio to grow. So it's just allowing tax to be deferred to a later time. Then we can do these, we can use these T-class funds here that will provide a tax efficient blend of income and capital. You can withdraw capital only, which defers you having to pay taxes on the growth of the investment. So let's say you invested $200,000 and you let it grow. You can start withdrawing a certain percentage, let's say 5%, which is $10,000 a year, tax-free for the next 20 years. Normally, you'd have to pay capital gains tax when you withdraw from your non-registered portfolio, but this vehicle allows you to withdraw your initial capital without triggering tax. So just a note here, occasionally when the funds do really well, there are distributions that are taxable. It's a bit of a complicated strategy, but it's very powerful for anybody with non-registered money. This strategy, coupled with withdrawing RSPs early, can really maximize the amount of money you receive in your early retirement years. By the time you have to pay tax on the non-registered assets, your RSP will be lower, so you won't be paying as much tax on it at that time. So since 2007, pension splitting has been allowed. You've been allowed to give your spouse up to 50% of your eligible pension income for tax purposes only. There's no need to actually give cash or write a check or anything like that. It's just a paper transfer done via the tax return. So if you're the recipient of the pension and you are older, you are 65 or older, you may split income from your registered pension plan, your RIF, your life annuity, and a few other qualifying payments. CPP sharing. So yeah, married or common law couples can split their CPP income once they both qualify for their payments. It's a bit of a complex calculation, but it's essentially a 50-50 split of the pension from the point you entered the marriage or the common law relationship.
Well, that's done internally in a tax return.
Yeah, exactly. Yeah. Just it's a complicated calculation if you wanted to figure it out yourself, but you both have to be at least 60 years old to qualify as well for the splitting. So this one's very interesting and it's not as well known. You can actually borrow money from your spouse to invest. You need to pay a prescribed interest rate to avoid attribution rules. So attribution rules were put in place to prevent higher earning people from gifting money to lower income earning people, having them invest it and pay a lower tax rate on the returns. Then the higher earning person would just take the money back. So the government doesn't like that. They want the higher income earning person to be taxed. But you can actually take advantage of these rules by simply paying a prescribed interest rate, which today is as low as 1%. Minimize your RSP withdrawals. So during higher income earning years, minimizing the amount of RSPs you withdraw to keep your total income in lower marginal tax brackets definitely makes sense. But that's really the old school way of thinking. If you have a few low income years while holding RSPs, it could make sense to withdraw some income at these lower marginal tax brackets. don't just necessarily wait till you're 71 and it's forced to be a RIF. Like we have people that are withdrawing RSPs at 55, 60, depending on their situation, right? So, yeah, it's like we said before, you really don't want to die with RSPs or registered money. So it requires a balancing act of not paying too much tax now, transferring money into a tax preferred vehicle, and making sure that you pay much less tax later. We're all about tax planning. So yeah, spousal RSPs. So if you're over the age of 71 and you still have some earned income that would have counted towards an RSP contribution, you can contribute to a spousal RSP as long as your spouse is under the age of 71. Okay. This one is very interesting. We like to use this a lot. It's where you can utilize the equity built into a universal life or whole life policy for the purpose of creating tax efficient income in retirement. So an added benefit is that the death benefit of the policy is tax-free. If done correctly, a life insurance policy can give you a tax-free income in retirement, as well as leave a tax-free amount to your beneficiaries when you pass away. That word tax-free is gold. We don't see that a lot. So transferring assets to a holdco. This strategy demands very thorough tax planning and should be done with your accountant. But if you're a business owner, there can definitely be advantages to transferring assets to your holding company. You may be better off leaving the money in your corporation instead of paying yourself a salary or dividend where the tax brackets are higher. But yeah, definitely talk to your accountant. This one as well. Some very thorough tax planning needs to be done here. Trusts aren't as amazing as they used to be, but there's still a place for them depending on the family situation. Might want to be taking advantage of your capital gains exemption through some trusts. That's really what they're still used for.
Assuming they'll
Yeah.
still exist.
Yeah, exactly. Yeah. So gifting assets, this is one of our favorites here for sure. So this should be done with your estate planning. And honestly, retirement planning and estate planning should be done at the same time because while we're doing the retirement plan, we might figure out that there'll be more money than you'll ever be able to use throughout your retirement. And then you might consider pre-gifting assets that produce taxable income to your beneficiaries rather than waiting for it to be done through your will. This will immediately reduce your taxable income and you can actually see your legacy play out before your eyes. And I know we have a lot of clients that's going on and they're just loving life right now. So
Yeah, absolutely.
yeah, so now I'm going to pass it off to Fred Senior here to finish us off.
Perfect. Okay, so I hope there was some strategies in there that may have made you think a little bit.
Yeah.
So what's our role in helping families with these strategies? Well, we need to go back to Professor Malevsky's recommendation. Treat your family finances as a business would. Now, you are the CEO. My role is to act as your personal chief financial officer and help you organize your financial affairs in terms of accumulating, dispersing, and transitioning your wealth as tax efficiently as possible. I can work with your existing professionals or offer you referrals to the professionals I work with. This ultimately is your decision. The goal is to limit the amount of money that is pulled out of your hands now and in the future. Let's face it, folks, we all understand the need, as mentioned, for tax in our society. But like you, we want to ensure that we take advantage of every opportunity to hold on to what is ultimately ours. So, what's your next move? That's up to you. We would love to hear from all of you and see if you can do anything to help. So, here are some questions that may be going through your head right now regarding meeting us for the first time. What will happen at our first meeting? Well, the goal for the first meeting is to really get to know each other and answer any questions that you might have. What will I learn that I didn't in this webinar? Well, we need to understand that this was a very generic presentation as it had to cater to public audience. We can delve into your personal situation a lot more with a one-on-one meeting. How long would this meeting take place? It usually takes 45 minutes to an hour. It all depends on the small talk and
If you want to talk about baseball bats.
yeah, absolutely. What should I bring? For the first meeting, you really don't need to bring anything. The point of this meeting is to learn about your story and get to know each other. There'll be plenty of time to dive into a more in-depth analysis, but if you think that you'd like to bring something, we usually like looking at financial statements, last will and testament. Will you try to sell me anything? No, we are not in the business of selling people on things. I think that we have proven here today that we are different than most advisors. We prefer to do things in a more relaxed, professional way. Our goal is to help our clients or our potential clients. How will I feel when this is over? Hopefully, you'll feel happy and smart. You'll be taking a positive step towards securing your financial future, and you'll hopefully walk away with some ideas that will help you reach your goals. Where will we do this? Well, right now, I'd like to say anywhere you like, but with the current conditions, we're doing a lot of Zoom and Teams meeting. Eventually, we like the interaction, the face-to-face interaction.
The handshakes, and
Yeah.
we miss that for sure.
Yeah. What are the next steps? Well, that is completely up to you. Maybe we decide we're a good fit and we end up working together. That would certainly be great. Maybe the time isn't right and you don't feel you need our level of service right now, and we agree to stay in touch. Either way, we'll help you as much as we can. Do we have any questions?
Yeah, so that's about it. We got a couple questions. I think the first question here, yeah, somebody's interested in my How to Adult program. So yeah, we'll definitely reach out. We'll definitely reach out about that. This is a little bit more of a personal situation. Okay, so I think I understand the question. So basically, like once all the money has gone through an estate, the question's basically like once it's gone through the estate, will it go to the beneficiaries tax free, or do the beneficiaries then have to include it as income?
It depends what.
So, well, that's why, like the RSP, for if it's an RSP, for example, it's going to be taxed to the estate, and by the time the money actually comes to the beneficiaries will then get it tax free.
Mhm.
So it's a bit of a
Well, not
complicated
tax-free,
question.
after tax. Yeah.
Well, yeah,
Yeah.
but like you don't have to claim it as income.
Yeah, so again,
Exactly.
we're talking about RSPs and RIFs. If it was
Yeah.
a TFSA, it'd be different.
Yeah.
If it was non-registered, again, it would be different. Life insurance proceeds that are destined to go to the estate.
Yeah.
What we need to understand is the estate becomes an individual, okay? And in Ontario, estates go through a thing called probate.
Yeah.
And there are fees associated with probate. So what happens is they want to ensure that all the taxes are paid, that the estate has paid all the individual's taxes, there's any outstanding debts, and then the monies are distributed from that point on. Depending on the clients that we have in front of us, sometimes we invest the money in a certain way where we actually bypass the estate and the money goes straight to the beneficiaries.
So we'll definitely
it's a
be
case by case.
Yeah.
Okay.
Another question there.
Okay.
Yeah, so here we go. Next question: are RSPs and/or RIFs taxed when they go to a spouse? So I guess we kind of just discussed that a little bit, but you can maybe take that a little
so
bit more.
the answer is no. It's a spousal rollover. So you're a married couple, one of you passes away, you each have a couple of $100,000 in your RSPs or in your RIFs. That money gets transferred over to your spouse tax-free as a spousal rollover. Eventually, when the surviving spouse starts taking the money out as income, then it will be taxed. The main problem is the second death with RSPs and RIF money. Again, if that rollover happened and the surviving spouse has, let's say, $500,000 and they pass away 2 years later, about 225,000 of that money will go to the government. That's so we try to, I'm not going to say avoid it. We try to find scenarios where we could aid and not that not happening.
Exactly.
Okay.
So the next question here is my primary residence and cottage taxed at my death.
That's a
So
question we see a lot.
Yeah, I can take that. So primary residences aren't being taxed today so far. I know there's talk about them potentially starting to look at taxing some of the equity that's in there. If you sell, there might be a deemed disposition. I'm thinking what's going to happen is it'll probably be for houses over 2 million or over 3 million when they're sold, there'll be some sort of tax. But for now, primary residences are tax free. Cottages or rental properties, secondary dwellings at all, those are taxed, and it's based on the adjusted cost base, which is whatever you paid for it. minus the fair market value minus that. So let's say you bought a cottage for $200,000 20 years ago, and today it's worth 500,000. Well, there's a capital gain there of 300,000, meaning that 150,000 would be included in your income. So you would probably pay a good $60,000 to $75,000 of tax on that. That's why you want to keep your receipts. Keep your receipts for any sort of capital improvements that have been made, because any sort of capital improvements will increase your adjusted cost basis. So that'll actually reduce your tax bill over time.
Okay.
So
I see a question from Brenda. Brenda, we're going to reach out to you because this is a personal question.
Yeah.
And we'll either send you an email or give you a phone call later on. The next question is, are TFSAs taxed as death? That's a really good question, because it's the answer is no and yes.
Yeah.
Why is it no? So if somebody passes away with a TFSA and the monies are transferred almost immediately to a beneficiary, then no, there are no taxes. But let's look at COVID as an example. So somebody passed away, let's say your mom or dad passed away, and things took a bit of time for the monies to get transferred due to COVID and funeral. Like, things are very complicated right now, and the monies were still invested for 2 or 3 or 4 or 5 months. The earnings on that money from the time of death to once they get into the beneficiary's hands will be taxed. Okay. The other thing that I want to touch on TFSA is that a lot of Canadians don't know, and this is particular with married couples.
Yeah.
You don't want to name each other as beneficiaries in a TFSA. You want to name each other as successor holder. Why is that so important? And you could only do this between spouses. The reason being, if one of you passes away, then those monies are transferred as a TFSA to the surviving spouse with all the attributes. So if you've maxed out your TFSAs and you're sitting, like we're seeing TFSAs right now, people have $100,000 in them. So if you each have $100,000, that TFSA we get transferred over 100,000. Now you'd have a $200,000 TFSA. If you named each other's beneficiaries, that $100,000 would be transferred as non-registered money.
Yeah.
So it does make
so any future growth on that money would then be taxed, whereas this other 100,000 coming to the TFSA, future growth would not be taxed. So it's very powerful to have a successor holder.
Okay.
I'm
I'm going to let you answer.
One more question.
So what is responsible investing? I keep hearing about that. That's a big topic of conversation.
Yeah, that's something that we believe in a lot. I actually do full webinars just on this topic. But basically, yeah, responsible investing is investing in companies that are environmentally and socially responsible and also have good governance practices. So we look at things like carbon emissions. We look at things like polluting water, other social aspects. Governance would be like CEO compensation. These are all either positives or negatives for a company.
And how companies treat their employees.
And how they treat their employees, exactly. So we're seeing that this is a very consumer-driven thing. So not only are consumers are really looking at, they're demanding more from companies that they're buying from. They don't want to just buy from the company that like treats their employees really badly. They're looking at like all these underlying aspects because we have so much access to information now. Governments are also investing a lot of money into green technology and all these things. So this is where I think the smart money is in the next decade. But even just in the last few years, it's really turned around, because like these responsible investing funds existed in the 80s and 90s, but that was like you weren't making a lot of money. It was just kind of a goodness of your heart kind of thing.
The people that invested back then were really diehards, and they didn't care about rates of return.
Yeah.
It was more of a principle form of investing.
Yeah.
Nowadays, we've actually been doing this for a couple of years now.
Yeah.
We've designed what we call hybrid portfolios, where we have a bit of conventional investing with the major fund companies, Fidelity, McKinsey, Dynamic, CI, and we've incorporated maybe 20 to 40% of ESG funds, responsible investing funds, and these portfolios are doing incredibly. They're doing incredible.
No, the last few years they've really taken off, and I can only see that continuing on a very good path. So we definitely want to be looking at that in the future. So
okay, Are we good?
I think we got one. This is another more personal situation. So that's why we don't want to get too personal on the call. So we will be reaching out to all of you. Don't worry
Yeah.
about it. We will answer all of your questions. So yeah. I think-
Okay, yeah, we're kind of running short on time here. So we'd like to sincerely thank everyone
Yeah.
for taking the time out of your daily activities and for listening to us. We'll be reaching out in the coming days
Yeah.
to see if there's anything that we can do to help you with your personal situation. This was simply part one of a part two
a two-part webinar. Yeah.
So again, if you want to book a meeting with us,
Yeah.
you could click on his face
Yes.
and you'll that'll open up in our calendar, correct?
Exactly.
Yeah. So please take care. Have a good rest of your day, and you know what? Be kind to somebody today. It's rough out there, and everybody needs to get through this. All
Yeah.
right. Take care.
All right.
Bye.
Bye.